Today, I'm going to talk about the loss utilization rules in Canada. So when you move up here, there'll be no surprises and you'll be able to maximize those loss carry forwards when you can. And as always, if you're a US business trying to survive the Canadian tax jungle, click on that subscribe button and hit that notification bell. Or skip the headaches altogether and contact me directly through the mactax.com if you want more personalized service. Okay, today we're going to break down the key differences in Canada and the United States when it comes to utilizing your net operating losses. And trust me, if you're an American business trying to expand into Canada, our loss utilization rules are going to come as a little bit of a surprise to you. Okay, so let's start with the basics. Number one, we do not call them net operating losses up here. We call them non-capital losses. Yes, we think that name is ridiculous too. We've just become accustomed to it. Number two, in Canada, you can carry back your losses 3 years or forward 20 years. My understanding is in the US, they recently changed the laws that you can only carry net operating losses forward. You cannot carry them back any longer. And that's pretty cool because then you can get more of an immediate benefit up here than you can in the States. And again, you thought we had tough tax laws up here. And along those lines, for number three, we do not have the 80% restriction up here that you do in the United States. I'm referring to, of course, that you can only offset 80% of your taxable income in the US with the net operating loss. In Canada, if the losses are available, you can offset 100% of your income in a year. Again, it's a softer treatment up here than you have in the United States. However, although we do not have the 80% restriction up here in Canada, there's little doubt in my mind that we are going to copy that law. 5 years ago, we copied your interest deductibility laws, and I find it very likely that we are going to be copying the 80% restriction as well. So stay tuned and we'll see if that happens in our fall budget. Next, I want to discuss consolidated returns. Up here in Canada, we do not file consolidated, nor are we like to anytime in the near future or even in the distant future, which has the terrible effect of if you have two Canadian subsidiaries and one of your subsidiaries has $1 million loss and the other subsidiary has $1 million of income, in the United States, you can consolidate these two entities together so your taxable income is zero. In Canada, no such luck. Your profit co is going to pay tax on $1 million of income and your loss co is going to have $1 million loss carry forward. I know that seems economically ridiculous, but we do not file consolidated up here, and that's just how it goes. I know what you're thinking. You'll just have your loss co charge $1 million management fee to your profit co. Problem solved. Taxable income's gone. Well, not so fast, because we have rules up here that prevent you from doing that. Rule number one, Section 69 of the Income Tax Act. All your expenses must be reasonable in the circumstances. And please keep in mind, Section 69 is a very powerful section. CRA can use that to deny the deduction in your profit co, but there does not have to be a parallel deduction in your loss co. Your loss co will still be recording $1 million of income, but your profit co will not have $1 million expense. That is the power of Section 69. Now, having said that, if in fact your loss co did provide services to your profit co and you wish to bill a management fee between the two companies, you may do so, but there has to be a legal enforceable claim. Okay, so you need a contract between the two companies that spells out the services and the cost of those services in order for them to be deductible in the profit co and incurred as income in the loss co. And don't forget that these fees still are subject to Section 69, that they also have to be reasonable in the circumstances. So absolutely make sure if your loss co is charging fees to your profit co that you have a contract in place for those fees. Our national sales tax up here is the GST or the HST, and there is a nuance in charging loss co to profit co's. I'm not going to get into now. It's too crazy, too convoluted. Just know that there could be a GST problem with that if you're not careful. So if you are charging management fees between your Canadian subsidiaries, give me a call at themactax.com and we'll avoid the HST problems. Okay, the next thing I want to talk about in regards to loss utilization is what happens when you want to purchase a company because it has loss carry forwards that you wish to utilize. And this one is really interesting because the rules in Canada and the rules in the United States are completely different. First off, if you have a profit co here in Canada and you want to purchase a loss co, the loss co must be in a same or similar business to your current profit co. If it's not, the losses will not be deductible against the profits in your profit co. And if you want to do this, you may want to give me a call, because what's considered a same or similar business isn't always that obvious. For example, vertical integration is not considered the same or similar business, okay? So be careful if you're taking this approach for that one reason. Another thing that you should be aware of is that when you purchase a loss co, the losses are only available to be carried forward. You cannot carry them back against previous year's income, which is reasonable in the circumstances. They have the same rule in the US. So remember, when it comes to loss streaming and you buy a loss co, you can only carry those losses forward. A final point I wish to make about losses, as it would have been difficult to incorporate it earlier in the video, is that if you start two separate subsidiaries in Canada and they are in two entirely different businesses, because you started them, you can amalgamate them and use the losses of one fully against the losses of the other. No restrictions. The restriction for the same or similar business only applies to you is if you purchased a loss co from a third party, okay? If you started both companies, you get full access to those losses, no restrictions on amalgamation. But the moral of the story from all of this is, when you're looking at expansion into Canada, you have to find a cross-border tax expert that not only knows the laws in both countries, but also knows the nuances of what happens when you expand into Canada. So if you're an American company expanding into Canada, don't risk tripping over our loss streaming rules. Reach out to me directly at themactax.com, and let's make sure your Canadian expansion is tax smart from day one. Before I get into my conclusion, I want to let you know what happened to me on the weekend. I was at a wedding where I had two businessmen, one on either side of me, and they were telling jokes about how do you make the wedding deductible. One said to the other, "That's easy. Just call it meals and entertainment over several companies. They'll never notice." I'm going, are these guys crazy? Then one of the fellow on my left, then he said to me, "Oh, I get audited every year. It's a rite of passage for me, and my accountant and I beat it every year." And I'm thinking to myself, Jesus, what business is this guy in? You see, we have businesses up here that get audited all the time, like constructions or restaurants. So when I asked this guy, "What business are you in?" What does he tell me? He's in clean energy. It's one of our favored businesses up here. I didn't have the heart to tell him that the reason he's getting nailed for an audit is there's something wrong in his books, something that his accountant is not bringing to his attention. Probably doesn't want to bring it to his attention because he's getting paid to fight CRA every year. The moral of the story, like I've said in many of my videos, your best weapon against CRA is clean books and records. Their algorithm can pick out sloppy bookkeeping like that and come after it. And I suspect that's what's happening to this fellow. And the moral of the story is, don't be this guy. Keep a clean set of books and records. You don't want to be audited every year and pay all those accounting fees. That is not something to be proud of. That is not something to be bragging about at weddings. And if you found this helpful, don't forget to like and subscribe for more insights on surviving the Canadian tax jungle. And as always, if any of this hits home in a way that warrants immediate attention, make sure you contact me through themactax.com and we'll get it all sorted out. Until next time, stay sharp, stay compliant, and stay out of tax trouble, and I'll see you on the next video.